Welcome back. Today we're diving deep into, well, a pretty hefty stack of financial reports. We're looking at Jindal Stainless Limited, or JSL, covering their Q2 and H1 performance for fiscal year 26, right up to the end of September 2025.
It's definitely a lot to unpack. Our mission really is to cut through that complexity.
Yeah.
We want to understand how JSL pulled off such fundamentally strong results, especially with some tricky global conditions out there.
Yeah.
We'll focus on what's driving demand here in India that seems key, and also tackle those policy headwinds they mentioned, like the QCO suspension and the CDAM confusion.
Okay, let's kick off with the big picture then, the consolidated metrics. These really show some impressive growth. Consolidated profit after tax, PI landed at 808 crore. That's up, 32.6% year on year. Huge jump.
It really is. And that PAC growth, it's important because it suggests they're managing those non-operating costs, well, things like interest payments, taxes.
Right.
Which is critical given their focus on cutting debt and maintaining financial discipline. We'll get more into that.
And pairing that with operational performance, the consolidated EBITDA earnings before interest, taxes, depreciation, and amortization that also climbed, it hit 1,388 crore, up 17% compared to last year.
Yeah, these aren't just small upticks. It suggests the growth is, solid, backed by efficiency and real demand through the whole first half of the fiscal year.
Okay, so let's dig into the volumes behind those earnings. JSL's Q2 sales hit 648,050 tons. That's strong growth, nearly 15% year on year.
And for the full first half, H1 deliveries were 1.27 million tons. That's a 12% increase over the same period last year.
And those volumes obviously fueled the revenue. Consolidated net revenue for Q2 was 10,893 crore, so up 11.4% year on year.
Which is interesting, right? The volume growth percentage is a bit higher than the revenue growth percentage.
Oh, yeah.
It might suggest maybe a strategic push across wider market segments, perhaps some slightly lower margin ones, just to really cement their market share.
Good point. And for anyone interested in the actual types of steel, the product mix breakdown for the quarter was, 49% was the 300 series that's often for critical uses.
Right, the high performance stuff.
Then 34% from the 200 series, more general purpose, and 17% from the 400 series, which you often see in cars and appliances. Seems like a decent spread.
It does. But, for me, the real proof of JSL's strength isn't just the volume or revenue. It's actually buried a bit deeper in the balance sheet.
Okay.
And this is why they seem so resilient, even with those wider economic pressures we need to talk about later.
Right, the balance sheet. That net debt to EBITDA ratio really stood out. It's down to 0.7x. They seem quite proud of their financial management.
And they should be.
Yeah.
As of November 2025, consolidated net debt was down to 3,646 crore. That 0.7x ratio, it means they could theoretically pay off their net debt with less than a year's earnings at the current rate.
Wow.
For a capital-heavy industry like specialty steel, where you usually need huge loans for expansion, that is remarkably low. Really quite something.
It almost sounds, too good to be true sometimes in this sector. A ratio under 1 is fantastic, but with the big expansion plans they have, are we sure this 0.7x isn't just, flattered by some short-term factors? Is it structurally sound?
That's the critical question, definitely. Management insists it is structural. They point to steady cash generation and, frankly, very tight control over capital spending for the last few years.
Okay.
And it's not just them saying it. Credit rating agencies agree. Their long-term debt ratings are confirmed at A stable, short-term at A1 plus trends. They've basically built this financial fortress, which gives them room to maneuver on their domestic growth plans.
Okay, so that strong financial base lets them push forward. Let's pivot to that demand side. What specific areas are really driving this growth within India?
Well, the main engine seems to be infrastructure. There's a real shift happening in materials used for public projects in India.
How so?
Think about things like flyovers, foot-over bridges, rail-over bridges. They're increasingly moving towards stainless steel because it resists corrosion and lasts much longer.
Right, less maintenance, lower life cycle costs.
Exactly. Government bodies are starting to see that long-term value, so it's creating this kind of permanent shift in demand, which is great for JSL.
And the railways and metro projects, that seems like another huge area.
Oh, absolutely. Demand from passenger coaches is strong, especially with the Vande Bharat sleeper coaches rolling out. Plus, you have all the metro expansions happening across various cities.
The scale of that metro expansion is pretty wild, isn't it?
It's staggering. They're aiming for nearly 1,000 kilometers of new metro lines nationally. If they pull it off, India could have the second largest metro network globally.
Wow.
Imagine supplying the high-grade steel needed for potentially almost 100 different metro projects simultaneously. It really shows JSL's capacity. And they're right in the middle of it, like supplying that special 301N grade steel for Bangalore Metro's Phase 2.
So beyond these massive government projects, what about consumer-focused areas? Are they still playing a part?
They are, yeah. Auto and white goods specifically. Auto volumes kept growing, and management expects that to continue into Q3, maybe helped a bit by recent GST cuts, they hope.
Okay.
And white goods, you know, appliances, consumer durables, that segment's also picking up, partly driven by the festive season boosting spending.
It seems very strategic, this focus on infrastructure. And they're not just supplying the raw steel anymore, are they? They're getting involved in the actual construction support side, too.
Exactly. That's a key move. They launched their first fabrication unit through a subsidiary, JSL Steelway Limited, down in Patal Ganga near Mumbai.
And what does that unit do differently?
It's set up to offer complete fabrication solutions end-to-end, specifically for things like bridges and other heavy infrastructure. Is vertical integration moving up the value chain to capture more margin, rather than just selling the basic steel coils or sheets.
Makes sense. And speaking of higher value, let's talk product development. That shift towards specialized products like rebars seems important for profitability, right? Especially with R&D successes.
Absolutely. They had a notable win developing these 410L rebars with SS500 strength. L&T is using them for the bullet train project. That's highly specialized, high-spec work.
And the Ratty Steel acquisition seems to be contributing here, too.
Yes, that acquisition from a couple of years back is really starting to pay off. That facility is running at about 75% capacity now, and stainless rebar sales are climbing steadily, averaging around 2,200 to 2,500 tons a month.
Why is that shift from, say, wire rods to rebars better for their margins?
Well, rebars generally command a better price. They need more precise processing, stricter quality control, and they're used in critical structures, high-speed rail, major bridges, where failure just isn't an option.
Got it.
So moving away from some of the more basic, lower-margin bulk products towards these value-added items is a very deliberate strategy to boost profitability per ton.
Okay, so we've got this picture of really solid domestic growth backed by strong financials. But now we need to look at the challenges, the external pressures that management called dynamic and challenging. Let's start with imports and policy issues here in India.
Right. This brings up that whole issue of a level playing field. Management keeps pointing to the ongoing problem of cheap imports flooding the market. They specifically mention subsidized, substandard, low-quality stuff.
Where's it coming from, mainly?
Primarily China and Vietnam, often misusing the free trade agreement routes, according to JSL.
How does that misuse typically work? What's the mechanism that hurts them?
Often it's about transshipment. So maybe low-quality steel from China, which should face high anti-dumping duties if imported directly into India,
Right.
gets shipped first to an FTA partner country like Vietnam.
Right.
It undergoes some minimal processing there, maybe just repackaging, enough to get a new certificate of origin.
Ah, okay.
Then it comes into India under the FTA, bypassing those higher duties. So the market gets flooded with cheap, often uncertified steel.
And connected to that is the quality control order, the QCO, suspension. That's a big worry for them, isn't it?
It's crucial. The QCO basically sets standards. It ensures only certified, quality-tested steel can be sold in India. It protects domestic players like JSL, but also, the end users who rely on that quality.
So its suspension is a problem.
Yeah, management called the temporary suspension until December 2025 concerning and discouraging. It effectively lowers the shield against those substandard imports. They're pushing hard to get it reinstated quickly.
Okay. Turning outwards then to exports. The global picture sounds pretty tough. Weak demand in places like the U.S. and Europe.
Yeah, ongoing trade issues plus just softer demand in those key markets makes exporting difficult right now. But the really big cloud hanging over everything is the EU's Carbon Border Adjustment Mechanism, CBAM.
Right, the carbon tariff. How's that impacting things?
Well, the main issue is uncertainty. The implementation details are still being worked out, and this has made global buyers cautious.
So they're holding back on orders.
Exactly. People are keeping inventories lean, delaying big purchases until they understand the full cost and compliance requirements of CBAM. JSL says they're ready to supply, they can meet the standards, but the market needs clarity. They're hoping for more details around mid-December 2025.
So it feels like JSL is building the strong domestic operation based on high-value infrastructure, but they're constantly battling cheap imports aided by policy gaps at home while also navigating this regulatory fog in their export markets. Quite a balancing act.
It really is. But despite those pressures, they're pushing ahead very aggressively on two big long-term fronts: sustainability or decarbonization, and a massive expansion of their production capacity.
Let's talk about the green initiatives first. The ESG numbers look quite striking, especially on renewable power.
Yeah, this is a big move, especially thinking ahead of things like CBAM. Their use of renewable power across their plants jumped to 42% in Q2 FY26. And just for context, for you listening, that was only 26% in the whole of the previous fiscal year.
Wow, that's a rapid increase.
It shows real commitment scaling up that quickly.
And it's not just buying renewable power, they're getting into new tech like green hydrogen, too.
That's right. They've partnered with a company called Greenzo Energy India to build a green hydrogen plant at their Jaipur facility. It's expected to be running by mid-2026, producing about 600 NMQ per hour.
So clearly preparing for a lower carbon future.
Definitely. It's about getting ahead of regulations where your carbon footprint determines market access and potentially affects pricing. Being proactive, not reactive.
Okay, now capacity expansion. They have some really ambitious targets here, which puts that financial discipline we talked about earlier into perspective.
Highly ambitious is right. The goal is 4.2 million tons per annum, MTPA, of melt capacity by fiscal year 27. That's a huge jump from their current 3 MTPA.
And the key projects are moving forward.
Seems so. The new melt shop in Indonesia is expected to start early next fiscal year, FY27. And expansions to their cold rolling capacity should begin towards the end of FY27. This kind of scale-up needs enormous investment, obviously.
Domestically, they also mentioned the PLI scheme, the production-linked incentive.
Yes. They noted it's positive that stainless steel flats and longs are now included. Management said they're studying the details right now to figure out the exact financial benefits and how they can best leverage it, trying to capture any government support available for boosting high-value domestic manufacturing.
Makes sense. And one final piece, which might seem small but feels important for the long run. Their Stainless Academy, training fabricators.
Yeah, it's actually quite strategic for strengthening the whole ecosystem. In Q2 alone, they trained over 6,700 fabricators. The cumulative total is now over 60,000 people.
What's the goal there?
It's about building skills, ensuring people know how to work correctly with stainless steel. This reinforces quality down the supply chain, makes sure the end products are durable, and ultimately helps maintain JSL's reputation for quality material. It builds loyalty too. Hashtag tag outro.
Okay, so let's try and wrap this up. What are the key takeaways from this deep dive into JSL? It seems like they're showing really resilient growth, mainly powered by strong domestic demand in infrastructure, railways, metros, bridges. And crucially, it's backed by, incredibly disciplined financial management. Those low debt ratios are quite something. And all this is happening while they're actively dealing with some serious headwinds that concerning QCO suspension, letting cheap imports in, and the global trade uncertainties around things like CBAM.
Yeah, the company looks structurally sound, no doubt about it. And they have this huge growth path planned out towards that 4.2 MTPA capacity target by FY27. Which leads to, I think, the big strategic question for you, the listener, to think about.
Okay.
Given how committed JSL seems to be, very publicly, to keeping those debt ratios super low, sticking to that 0.7x net debt to EBITDA benchmark,
Yeah.
how exactly are they going to fund the massive capital spending needed for all this expansion, especially the new facilities they're proposing? Will they manage to do it without compromising the very balance sheet strength that makes them so resilient right now?
That's the core tension, isn't it? Massive growth ambitions versus strict financial discipline. That'll be the story to watch. A really fascinating look at a key player in India's specialty materials sector.
Always interesting to dig into the details.
Indeed. Thanks for joining us on the deep dive. We'll catch you on the next one.